Hey everyone, welcome to another video. So this is my second time recording this video. Unfortunately, the resolution on the first one did not go so well. So we're going to do this again. So welcome to a market structure video. This is probably going to be the most in-depth market structure video that you haven't seen, because this is going to go over about a lot of topics that are constantly missed in all the other videos. I wish that I had a video just like this when I first began trading. And so I hope that this does as much for you wherever you are in your journey as it does for me now, knowing what all this means, right? So the whole idea behind this is that I see most of the mistakes that people make are in identifying market structure and its behavior, right? So market structure isn't always perfect and it can look a little bit messy. And one of the most common things that people get wrong and struggle with is market structure. It's easy to be overconfident when it comes to this topic. And so I want to show you what I've learned and what I think about it, how I identify it, how I can avoid making mistakes and falling into traps with what I've learned. This is not everything that I did not make any of this up myself. These are things that I've learned through many different systems and many different courses, many different communities, things that I've applied and that I've learned myself, things that I've refined, whatever. It's a conjunction of a bunch of different factors, right? And so I want to get into this video and, to preface the idea behind this, and I might make a part 2, right? The idea behind this one is strictly to go over the details of market structure, how it applies and how it interacts with supply and demand, and how to use liquidity to your advantage and understand what liquidity is doing alongside market structure and supply and demand. So later might make a video talking about like minor structure, substructure. To be honest, those things are super covered in like so many other different videos. At the same time, I've made a how to build a higher time frame story, and the higher time frame story video, that one's already up, and that one should give you an idea of how you should look at market structure as a whole, right? From the weekly, daily, all the way down to, I don't know what I went in the video, but maybe to the 1 minute, as I usually use for my execution trading. So let's get started. So in all these examples, most of these examples, I'm going to be using bearish order flow. Now I can see that maybe that might be a little bit confusing if you don't understand just how to flip it upside down and then do the opposite. So I'm going to try to give you as many examples and to be as clear as possible in this video. So the first thing that I wanted to go over is, what is the expectation of market structure? So if we look down here, right, the idea behind this is whatever it is that we are doing. In this case, if we're bearish, when we turn bullish temporarily, it's simply as a form of pullback. And that pullback usually rides until we hit a higher time frame supply that is strong and is responsible for the break of structure to the downside. Simply a supply that needed to be mitigated. Mitigations might be for another video, right? Then what do we have? A continuation to the downside as we are overall bearish. So at this point, the higher time frame is bearish. So the continuation to the downside is what breaks structure to the downside, right? Whether the volume or momentum behind that break of structure, that's another part that we're going to cover in this video, but that's what the continuation is. Once we've satisfied the break of structure, now it's time for another pullback. And we get a pullback, and typically the pullbacks are going to be very corrective in their nature, because all we're doing is we're building liquidity to take to further the move to the downside. As the pullback is completed, as it comes into a higher time frame supply, and that supply is responsible for the break of structure to the downside, it could be the extreme or the decisional. We're going to go over that in the same video, right? After the pullback, we get the continuation. So the market is a conjunction of, right, accumulations, distributions, corrective buildups of liquidity, impulsive takes of liquidity to further the higher time frame intentions, more pullbacks that are very corrective, and impulsive push to the downside, in this case for continuation, or the opposite. If we're bullish, what is the continuation? The continuations are expected to make new highs, and the pullbacks are pulling back price lower until a nice demand zone to create continuation, right? So That's something to keep in mind. Corrections and pullbacks, impulsive continuations, right? The other thing that I wanted to go over is when you're looking at the charts, what is the power of the break of structure that we make, whether we're bullish or bearish? Whatever is happening, this is something that I've learned that is very effective. So keep this in mind, test it, back test it. You might see that this is going to help you a lot, right? So when I see low momentum breaks of structure, now what is it? Low momentum, low volume, right? Look at the difference between these. When you see a lot of aggression and power running through the markets, destroying creating a new break of structure with so much power, right? This is what the difference is. When we have a low momentum break of structure, typically you'll see a pullback that's corrective that takes you to a decisional point. It's not the extreme, it's not the origin of the move, but it could be a flip zone that's unmitigated, an area that is responsible from which price decided to commit to take price lower. And that's what you see. Now, on the other circumstances, when we see high momentum breaks of structure, in this case with a lot of power and volume and momentum, typically what that means is that more than likely we will come back to the extreme. In those cases, usually the extreme or the origin of the move is going to be the source of unmitigated liquidity, of resting orders that we will require to continue the move to the downside. So just taking the knowledge of, having a pullback and continuation, the correction and the impulse, combining that with the idea of how powerful are the break of structures, you can really understand and calculate to what you should be looking for potentially, right? Not that 100% of the time it's going to happen. A lot of times price can just simply come into a 50% level and that's enough to satisfy the move. We might come into 50% of the range, right? And so you're going to see examples of that, and you'll see that when you start trading more, whatever level you're currently at. But these are two things that if you have not noticed yet are really going to change the game for trading, right? So in this case, we're bearish, right? So this is the continuation. We break structure to the left. We have a pullback, right? We have an extreme. Price break basically gives us a signal that we might be shifting back to bearish in continuation form. Then price, we get a pause in the market, we create a range. This is the decisional where we decide to commit. The sellers decide to put in all their orders, and this is where they shift and they break structure to the downside, right? It's obviously going to look more like this, for example, with some pauses and pullbacks, but an unmitigated decisional is in this case what we'll probably come back to. And in high momentum, we'll come back to the extreme, right? So that's one thing that I want you to remember. Now, when it comes to market structure, something that I'd like you to really think about is if we look at this chart here, a lot of times, just because we think that price is bearish, we're like, oh, we just broke structure to the downside, we're breaking structure to the downside, we should just continue, let's just keep taking supplies. Price breaks structure, and you might not even notice that to the left, it already broke the higher time frame structure. It might already broke the low to the left, or the high to the left if we're bullish, right? But once you see that happening, once we've taken the previous low and we are finished with the continuation phase, we are now shifting into a pullback phase where we have a very corrective pricing. And so when we see that, you should not get confused and begin to think that because we were short for so long that you can just take any supply. Because when you see price come back to a supply and we see a reaction from it, and you get excited thinking that you just caught a really cool short that's probably going to make a new low, you're going to be disappointed because we're now switching from continuation to a corrective pullback phase. And we're going to keep taking you out every single time you see something like this. When you think that, let's say, supply is beginning to be respected, you're going to be disappointed to find out that in the pullback correction phase, you don't want to take these levels because these are going to be liquidity to serve for the pullback push back up to a higher time frame supply. Same as when we're bullish, right? So price was bullish here, and once you get a change of character, shift in order flow, right? And the expectation is now shifting from bullish to bearish, don't take every single demand, because if you keep buying at these levels, you're going to keep getting taken out time and time again. So the main idea behind that is what I wanted to explain is focus on continuation of market structure from the higher time frame, right? Reversals are only signaled through confirmation. So if the higher time frame, if we're 4 hour and 15 minute, let's say we are bullish, right? Keep taking bullish price action. Don't get deceived by shorts when the higher time frame is bullish. Same when it's bearish, right? If the 4 hour and the 15 minute are bearish, right? Keep taking continuations to the downside until we take the low and we break structure, until we get back into a pullback correction phase. Then pause, reanalyze, and then figure out, are there going to be trades that I can take that are counter trend and to the higher time frame supply that I could ride and then ping pong price back into its continuation phase, right? So, most of the time, a lot of people will be caught on the wrong side of the market. Even when price looks very confusing and looks like it's just building liquidity to take and flip, if you look at any chart, most of what you're going to see is continuations. It's very rare that you're going to see reversals. Reversals only happen 2 times in each cycle. I mean, let's look at this. Obviously, this price action is kind of crazy, but maybe if we look at something slightly more clear, let's hit the 1 hour. Sometimes the 1 hour is pretty clear here. So, for example, here, what are we doing? Let's say we're bullish, right? So let's switch this to bullish really quick. Just gonna do it like this. The expectation is when we take a high, right? We break structure, that the low is going to hold, and we're gonna go over that more. This is the current high. When does the high get violated? Right there. What is the extreme? There's different levels. We have this level that is responsible for the break of structure. We also have the extreme and the decisionals, right? And price can come back to mitigate any one of those levels. This is that's the most recent high. When is it breached? Here. Well, we have this level here that we could be looking. We have levels in here, right? A sweep that price could come down to tap into, right? And so when do we get reversals? I mean, look at this price action where this is, let's say, the low. Realistically, your best reversals only appear because, and even here, look, this is counter trend, right? Like, we're probably expecting to make a new high. So if you're taking shorts from here, you could be very quickly disappointed because, price is not really predictable in this case. You're thinking that, okay, we have a high here and we might make a new low. Well, the low is here. It's not going to breach it because we're currently bullish. So when you're taking counter trend trades, understand that you are going against momentum. You're going against volume, against the higher time frame expectations. So trade pro trend, right, until you master pro trend. And remember, 4 hour and 15 minute are bullish. Keep taking price bullish. It's unlikely you're going to get lucky with the reversal, somewhere in the middle of pullback with some sort of reversal, or somewhere in the middle of a continuation. Pay attention to the higher time frame structure until, let's say, the low goes, and when it's bearish, we have no reason to have a pullback, right? Until the high goes in bullish structure, there's no reason to have a bearish pullback. So take continuations. There's continuations everywhere in the chart versus you're only going to have proper reversals, like 2% of the time, right? So how can we identify when market structure is beginning to shift? There's a couple of things you can look at, and 2 things that I think are the most helpful to take into account is, well, what? If we are currently expecting in a bullish order flow, bullish market structure, we're expecting to make a higher high, a higher low, a higher high, a higher low, a higher high, a higher low. If we fail to make a higher high, if we fail to make the next expected point in market structure, the next expected level, that could be a sign that we may be beginning to find weak weakening market structure, weakening demand. We might begin to see that we're building liquidity, we're in a complex pullback, and we may begin to shift, whatever happens, right? So if bullish, a failure to make a new higher high, that's a sign that we're finally getting some weakness, right? Weakness, not a reversal, weakness, right? If price is bearish, a failure to make what? A new lower low. We make what? Now that we've shifted, we have a lower low, we have a lower high, lower low, lower high, lower low, lower high, expectation is lower low. We fail to make a lower low. We could be in a complex pullback, we could be building liquidity. It's not a sign of reversal yet, but it's one of the first signs of a potential reversal. Once we fail to make a lower low, what's the next thing that could happen? Well, a shift in momentum and a break of protected levels. We're going to talk about protected levels and strong levels or weak levels / targeted levels, right? So, if we look at the chart here to the left, well, a strong level is responsible for breaking structure. So if we're bullish, the expectation is always going to be that the demands are stronger, and that's why we're breaking and making new highs. We pull back, continuation, right? What is this? A strong level that breaks a previous high, right? Bullish is higher high, higher low, higher high, right? Breaks the previous higher high, higher low, breaks the higher high, new higher high, higher low, breaks the higher high, right? So the demand is strong or the higher low is strong, right? So in this case, the expectation is to go bullish. So an area that is strong is one that is responsible for breaking structure and the direction that the trend is going. Now, when is it weak? Well, if we take into account this first, let's say, demand, what do we have? Price pushes price higher. This fails to break structure to the upside, and because it makes equal highs, which is not a higher high, this is basically a weak demand, a weak low, right? The higher low is not making a higher high. So what's the expectation? Are we shifting? I don't know. In this case, because we're currently in a demand, in a corrective pullback, and we're building demand up until a supply, we could see what? Buyers come into the market and push price higher, leaving behind equal levels, right? That we could sweep the highs because what? We're bullish, right? So these equal highs are swept, but we leave behind equal lows. Well, we're not going to target the lows because we are currently bullish. We might leave this behind for later, right? We don't have to immediately liquidate equal levels. A lot of times they're going to hold. If you think about it, it takes billions and billions of dollars to make a new level, to develop a demand range. In here, whatever time frame this is, on the lower time frame, it's an accumulation that's happening. We're accumulating buy orders here to take price higher. Once we make the expansion to the upside, we have to pause, we pull back, we build more liquidity, we're building more accumulation of orders, we have another expansion, and we make new progress, right? The continuation, we pull back, build liquidity, expansion. Same thing when we're here on, let's say, on the bearish side. What are we doing? We're distributing orders, we expand to the downside. We pause, we build distribution of orders, and we expand to the downside, right? So a protected level is a level specifically responsible for breaking structure in the let's say direction of the higher time frame trend. So this low makes a new high. We get a pullback to make what? A higher low, and then we make a higher high. The expectation is we make a higher low and demand is hold and protected, whether it comes down to tap it to make equal levels or it doesn't even come close, right? Like in this example. But once we get a failure of that protected level, once we get a shift in market structure and momentum and order flow, a first sign of weakness of demand, because now demand is broken. And so now what we are seeing is a potential shift in order flow to the downside. One sweep is not necessarily a reversal, but this is a sign of weakness that could create a reversal. And that's why we use these two things together, along with other things that I'm going to show you, in this video, right? But once we get a shift, we broke a level that was supposed to be protected. Now we begin to see that weakness. Now, same thing in this case, that was for bearish. If we're bullish, what do we, if we're bearish switching to bullish, right? Because this one was bullish switching to bearish, we break the demand, we show supply is stronger. The sellers are strong enough to take out a demand level that was responsible for creating progress to make a new higher high. In this case, we're making lower lows, we're making a lower high, a lower low. Expectation is what? Lower high, and then lower low. We failed to do that as we did in part one, right? And what have we done? We've taken out a protected supply. That supply initially was considered strong as it broke structure to the downside and showed that the sellers were very strong. But once we've tapped into something else, we've liquidated this level, and we've probably tapped into something to the left that if we look back, we can see might be an unmitigated demand zone that might satisfy the need or create a pullback, right, or a shift in order flow from bearish to now bullish. We've broken a protected level that was responsible for printing a new low. And that's the second sign of shifting momentum. So you combine those two and you have a powerful way to identify potential shifts in market structure. Now, we could also be doing so to capture liquidity, and that's why it's important to keep track of these two things. By the way, I don't know if I mentioned it in the video, but if this whole thing is going to be available in the link to the description, so if you want to go back to see this later, save it, study it, whatever you want to do with it, the link to this diagram is going to be in the description, right? So one thing, here's a tip. When we take out two levels of structure on any time frame, we have already shifted and had confirmation. This is something very powerful that you can use because a lot of times, and we'll go back to this example later, but this one's a bullish pullback, for example. We have equal highs, price breaks structure to the downside, and what do we think? We think that what are we doing? We failed to print a new high, and we've broken a protected level potentially, right? In this case, we're making equal lows, so this is not a strong level, right? Now, if this took out this level, it would be a different story, right? But because this level just failed to print new highs and it swept the low, right? A sweep is not classified as a full shift because that level was responsible in the shift, has to be responsible for printing structure, a new break of structure to the upside or to the downside. In this case, this low did not print a new high. So this low is the one that needs to be breached, right? And so let's see another one. Like here, this low prints this high. This low prints this high. In this case, because this low printed this high, what does this give us? Well, we break structure to the downside, right? So this gives us what? We're taking structural liquidity. This was responsible, it's supposed to be a protected demand level because it printed a new higher high. So when we break structure down to the downside, we are basically thinking we've already had that shift in momentum. But what do we not have? We have yet to attempt to print, let's say, a higher high. In this case, all it did was sweep, taps into demand, and continues the higher time frame intention, right? So what I like to use is when you take out two levels of structural liquidity or structure on any time frame, whatever time frame you're trading, then we have shifted and had confirmation. And I have an example of that. This one right here, if we look to the right, this is what it looks like. Let me zoom in just so you can see what I'm talking about. Because I know that my screen's pretty big. If you're on your phone, it's going to be a little hard to see this, right? So let's just say we are bearish, right? So price is pushing to the downside. We've tapped, we push price up. We look like we might be shifting potentially bullish for a pullback, right? Just a pullback, continuation, corrective pullback, continuation to the impulse downside. What do we have? Formation of equal highs. We're basically building liquidity, and we sweep because what does this do? This low is not strong enough to print a higher high. So we have to search for orders below. Price sweeps the low, comes lower, taps some sort of demand zone, and then we get what? Break of structure to the upside, right? Now we're currently bullish. We have here, we have a high, we have a higher low, a higher high. What do we have? A sweep, another sweep, right? In this case, what did we do? We swept structural liquidity. This was supposed to be a protected level that broke structure to the upside. And so when we see this, a lot of people are going to be thinking that we're immediately shifting to what? To bearish order flow now. Well, it's a little early for that. We broke 1 point of structure. What do we have? That liquidation creates an aggressive reaction back to the upside. And we see that time and time again. I'm going to show you examples, right? Then what do we have? Price is starting to shift. It looks like it's weakening, but we have this low and we have this high. So order flow is still, bullish. We're just in a complex pullback, right? What do we have here? We have a reaction. Price pushes up. This supply zone, this is a point of failure. This creates a break of structure to the downside. And we get two breaks of structure. So this one was a protected level. What do we have? This low broke structure to the upside. It took out this higher high and printed a new higher high. This break of structure, right? This higher high, lower high, higher high, printed a new high. This is structural liquidity. When we take 2 points of structure, you can be very sure and very confident that that's an official sign that we are shifting market structure from bullish to bearish. Same from bearish to bullish. When you get a break of structure that takes out two levels on, let's say, of supply, you can bet that we are shifting bullish, right? Now, it doesn't have to look clean like this, that one candle does this. You could also see it like this. This one took one level. We get a pull back, right? Continuation, and this one breaks the second level, right? It can look multiple different ways, but once you take 2 points of structure that created structural liquidity, right, that were responsible for printing new levels and let's say in the trend direction, then you can bet that we are shifting. In that case, what I would do is I would trade off of a pullback, right? Looking for price to come back into an unmitigated area that broke structure. It could be this one, or it could be the extreme, and then I would get the continuation to the downside. So you can see that both ways it's going to work, right? In this case, I'm showing you that one supply broke 2 points of structure because that's a sign of a lot of strength, right? Now let me bring the chart back to where we currently were. Let me organize this again because I had to zoom in. So let's see here. All right, this looks clean now. So that's important. So remember when I just went over the structural liquidity thing. So something to remember that will help you. And for this example and for these, if we do not have the strength to continue the higher time frame move, let's say here, make a higher high. What do we have? A higher low. Fail to make a higher high. What could happen? We may need to search for resting orders by taking liquidity. An example, sweeps of equal lows or equal highs, any equal levels, or structural liquidity, right? Don't take it as a full reversal, right? So use confirmation. Now, one thing to just cover, if we look to the left here, all of this is trend line liquidity that we're building. So each time that we're pushing higher on price, we are taking liquidity. But in instances like this, where we are, let's say, on a pullback corrective phase, and we fail to make new highs, what we could see is that this higher low, this level, sorry, I blinked out for a second. This is a higher low. So this higher low failed to put in a higher high. So that tells us that this level is weak. And because there's not enough orders at this point to break structure to the upside, we may have to search lower. And that's why we get a break of structure here to the downside, but really what it is a sweep. It's an internal minor sweep, right? We swept that low that was supposed to be protected potentially, right? And then we continue with aggression to the upside with the higher time frame intention. So if you look, there's different cases. For example, to the left, what do we have here? We have equal highs, right? This is going to serve as inducement, right? So equal highs that in this case, because they're in the direction of the higher time frame trend, we are going to liquidate them. But we also have what? Equal lows. These are not going to be targeted now because we have enough demand to push price higher. In fact, these will be targeted later. They don't need to be swept. But in the case, let's say here, in this case, let's just say they are weak because we've printed higher highs and we don't have enough demand to continue price. If we see a sweep, we should not take that as a sign that we are going to completely shift order flow to bearish. Not yet, right? Not until we fulfill the higher time frame intentions. Now, remember there's premium and discount pricing. So the idea is you don't want to take, let's say, shorts from, let's say, below in discount pricing. You want to take it from premium pricing, right? So the same way that you don't want to buy in premium, you want to buy in discount. That's the same principle. We still have yet to match the higher time frame intention, which if you look back up here, depending on how the momentum is on the break of structure, we might look for something like this. Now, sometimes, like in my ranges video, you're going to see that price may just come to the 50% level, but you're also going to see that when you look on the lower time frame, that level has a very strong supply or very strong demand level that it came back to mitigate, right? Now, in this case, it's a little bit different, right? So that's the importance of this. So remember, if we do not have the strength to continue the higher time frame move, we may need to search for resting orders by taking liquidity, right? That will be equal levels or structural liquidity. And remember, don't take it as a full reversal. Use confirmation. How can you use confirmation? Well, once on whatever time frame you are looking at market structure, once we take out two levels of structure, right? Structural liquidity, they break structure on the higher time frame trend and that time frame's trend. Once we break that, that's when we've shifted and had confirmation, right? So that's important. So remember, market structure, how to identify when it's shifting and showing weakness, that we could see reversals, right? How can we get confirmation? Through noticing the strength of, when we start taking out multiple levels. We went over the correction, where we have pullbacks, where we have continuations, impulsive continuations, right? So now we're going to go over this level, and we're going to talk about strong levels and weak levels, right? So a strong level is anything that is responsible for breaking structure to the upside. When we are bullish, demand is strong and supply or the highs are weak, right? When we are, bearish, the lows are going to be weak and the highs are going to be strong. And the reason why is because to move price from high to low, we have to continue to make progress to the downside. So the impulsive nature of the market will favor shorts, and the corrective pullback will favor pullbacks to supply zones and then continuation to the downside. It will be it's a war between buyers and sellers, and you have to follow the higher time frame intention because that's where volume and momentum are favoring the movement of price, right? So every time that we have a strong level and we break structure to the upside in this, let's say this bullish corrective pullback, we're leaving behind a strong demand level, right? And later we may or we may not get reactions to it. So with supply demand, we'll have three examples. Either supply and demand will hold, and if it's respected, we expect continuations, right? Bullish will leave demand zones, strong demands will make new highs, bearish will leave supply zones, strong supply will make new lows. That's number one. Number two, it could provide a reaction, and all the reactions are green. A reaction, and then it can get liquidated. So for example, let's say we tap demand, right? We're now in the continuation impulsive bearish move. So we tap a demand level, let's say, we react to form an extreme, and if that extreme takes liquidity, right, or fails to take liquidity, but it runs the point of interest, let's say the initial reaction, then that could be a potential entry at a mitigation of that level for a flip, right? And I have two examples here that we'll go over, right? So if we look here, let's say to the right of the chart, let me zoom in here. So this will be the most clear way that you can see it. So same thing. Let's say we're in a bearish market. So we're pushing to the downside. We push back up here, and we are building liquidity to the downside to tap this demand zone, right? This is a demand. We tap it, we give a reaction, and this reaction pushes up price to form an extreme that also sweeps internal structure. So here we're making what? Lower lows, and we're making lower highs. Lower low, lower high, lower low, lower high, lower low, reaction because we're in a demand zone, and we sweep a previous lower high. When we get that sweep, we're taking liquidity. And so this is a liquidity point of interest. And once this is validated through the break of structure back into the continuation to the downside in an impulsive nature, and it breaks the initial reaction, extreme, break of structure downside, we now know that we've left behind what? This is a supply range, and this is an unmitigated zone that took liquidity and broke structure. That's extremely important. So this reaction swept liquidity and broke structure and continuation. We will enter at mitigation of the flip extreme. So when you see price pulling back up to it correctively, you want to take a trade from this level, continuation to the downside. And because we've already had confirmation of a break of structure, whether it's internally or swing structure, you can see that this level was responsible for the breakage. So you can feel pretty confident that this level has no reason to fail, considering that all the volume and momentum entered the market at this extreme to push price to break structure. Previous to that, all it was doing was creating liquidity for the taking for later, and some that was swept now, right? The next thing that we could have is a reaction that did not sweep liquidity. In this case, reaction did break structure in continuation. In this case, we can expect the reaction to become liquidity and enter at a strong unmitigated point above, POI above, right? So in this case, what do we have? Bearish market structure. Here we have demand that we're creating. Corrective pullback in this case. We're making lower highs and lower lows. Price comes down, taps demand, and at this point, what do we have? Buyers push price up, and there's so few buyers that what happens? Market just melts and falls straight through and breaks structure to the downside. In that case, we're showing the weakness of buyers. They were not even able to sweep any liquidity. In this case, this will serve as structural inducement, as is broke structure to the downside, similar to the examples on the left that I was showing you. So what we can expect is on a pullback, price will come and sweep that level of liquidity and tap an unmitigated, stronger supply above. And that's exactly what would happen. So if you are looking at flip opportunities or areas where we get reactions, whether if you are bearish, you want a reaction to demand zone that forms an extreme and takes liquidity and breaks structure, right? Or, if we're same thing, we tap into a demand zone, fail to take liquidity, but we break structure. So we target above that zone as this serves as inducement, right? Or if we are bullish, right? Same thing. We tap supply, we form an extreme, and then we break structure. We show our bullish intentions into the market, and we saw that that buyers were stronger than sellers and were able to overpower them. So that's what flips are, and you're going to see those everywhere on the chart when you start to really look at what market structure is doing. And I'm going to show you they're very common, and you can spot them everywhere. So let's go over the diagram. So now that if we look to the left again, right, remember we're bearish market structure in these examples here. So, and then let's zoom in enough so that it's clear, whatever device that you're looking at on. Zoom in like this. That should be pretty clean. Okay, so let's say here, we are currently in this leg, a corrective pullback. So what we're targeting is the next potential strong supply that's going to hold, right? So demand is strong, takes these levels that are weak, right? Highs are weak as we are constantly making higher highs, right? We're protecting these higher lows, right? You can see here, break structure to the upside here, some mini pullback, but we break structure to the upside, we pull back, in this case continuation to the upside, we leave equal highs here, showing some sort of weakness, right? You could take this as potentially there might be a shift here, but when we take a look into price and we're like, we have not yet tapped a higher time frame supply zone that is strong, right? For example, like the decisional or the extreme, right? Or a flip, there's no reason to take a short here. There's enough demand that we leave behind equal lows without sweeping them, and we break structure to the upside. And therefore, this level here is strong because this was the low that broke structure to the upside. This one was an equal low and therefore is protected by default. But this one is the one responsible for breaking structure. Now later, this is going to serve as inducement. Liquidity targeted equal lows. We don't need to sweep it now because there's enough buyers in the market to take price higher. So here, what do we have? A higher high, a higher low, a higher high, a higher low, a higher high, and here, what do? We fail to do number one, which is print a higher low and a higher high. Here, what do we have? Well, this area was responsible for printing a new high, and therefore, previous to this level, before this one existed, this was the low, and this was the high. Therefore, anything that happens in between is just a complex pullback that is temporary, right? But what did we have? We have this level that pushed back and created a demand level here that broke structure to the upside. Once we tapped into the higher time frame supply on the left, right, that we mitigated, we see that this area is responsible for a shift in order flow. This red line indicates a break of strong demand because this demand broke structure to the upside. Even though it looks small, it's valid, it broke structure to the upside. When we take this level, we've officially done two things. We failed to print a higher low, and we failed to what? Make a higher high. We actually failed to protect this demand zone. So this is the official shift. We've taken 1 point of structure. Now, what do we have? This is a strong level because this broke a level of demand. Even if we're still expecting to continue bullish, until we are fully confirmed that we are bearish. For example, what happens here? We tap into this demand zone. This is the demand zone that pushed price that just failed, that just got swept, basically. We took it out. So this is the next level of demand. And as you see, we continue to make price come back to each level of demand, each level of supply we give reactions to most of the time, right? So we give a reaction to this demand. So now it's a war between buyers and sellers. We know that the sellers of this higher time frame supply are so strong that they broke a protected level and they shifted market structure bearish. But we don't know if they're strong enough to take out this demand. So we wait. We get a reaction. Now buyers are showing buying pressure and they're pushing price up. Because we push price higher, but we fail to do what? We fail to print a higher high. At this point, what we could have had is what? A sweep, right? Because we said if we do not have the strength to continue the higher time frame move, we may need to search for resting orders by taking liquidity, sweep of equal levels, or structural liquidity. This is structural liquidity. We just swept it. And so we still have potential hope. We're not confirmed that we're fully bearish because this has not yet failed. We haven't had 2 points of structure break yet. So if this did commit, and we broke structure to the upside, then we can expect to continue bullish, right? That's the expectation. But what happens? We fail to do that. We form an extreme. This extreme does not make a higher high, and all it does is it creates failure of the initial reaction and the demand we reacted to. So this demand failed, the reaction failed, and now we have what? A shift. Previously, The highs were weak, the lows were strong, and now it looks like the highs are strong and the lows are weak. We're breaking the lows and protecting the highs. Here we have confirmation through the second break of structure. We broke the first one here as we tapped into the higher time frame point of interest. We've had an attempt for buyers to take control of the market and they failed. We've had a shift, and that shift broke structure to the downside. We've taken two levels. We now have confirmed a shift in bearish market structure. This is a flip. So now what can we expect? We are now making lower lows and making what? Lower highs. Lower high, break structure to downside, lower low. We leave behind supply. Whether it's mitigated or unmitigated, we have supply. Then what happens? What's the third thing? So supply and demand will what? Hold, provide reaction and get liquidated. And the third one is just become liquidated. So here we have equal lows. And like I said, it's liquidity that we're going to target. You want to make sure that your market structure and your supply and demand, your theory, whatever you think is going to happen next, is supported by liquidity, because that's what we are targeting. So this is where we had a lot of buy orders. We failed to sweep these lows. We made equal lows, and each time we had buyers push price higher. Buyers push price higher. In this case, it was a previously strong level. But now that we are shifting to bearish, any levels that were strong previously are now going to be considered weak. And therefore, they are going to either not hold in this case, but they could hold, right, if we were going to continue in their continuation of the previous bullish structure. But now that we've shifted officially with two breaks of structure, now the only option is they're either going to provide a reaction and get liquidated, which, remember, if they provide a reaction, we can get what? A potential flip, right? Reaction, form an extreme that takes liquidity or doesn't take liquidity, break a structure downside, we enter at a mitigation of that zone. We don't necessarily will always get those, but that's what we expect, right? So now we're continuing to the downside. This is equal lows that were strong. Now we liquidate those areas. No reaction in that case, let's just say, right? We're here in the middle. We've paused. Supply is still in control because we have not come back to another demand zone. We just broke another demand zone. We have what? A lower high and then a lower low. Boom. We tap into what? We swept this strong level and we've tapped into another strong demand zone. We tap that reaction. This reaction does what? Well, we have the option. Remember, in a flip, it can either sweep liquidity, right? And if it sweeps liquidity, right, and it breaks structure, we can expect a mitigation of that level. But in this case, it doesn't happen. Price does what? Supply is going to hold because we are currently bearish. So price comes back up, taps supply. This supply was responsible for break of structure downside because this was the lower low, lower high, lower low. This one broke this low, right? Therefore, this supply is going to hold and break structure, new lower low. This gave us an opportunity for a pullback, and that's the whole idea. Every time we get a reaction, you have to see where we're coming back to, and if potentially we can take an entry at that mitigation, or upon a mitigation of that mitigation, if price comes back, like something like that, right? So we're continuing to the downside. Here, what do we have? This demand. Demand appears to be holding. We now have made equal lows, right? Someone is going to be buying off of these levels. The buyers push price up. They fail to make a higher high. The only time we get the reversals, remember, we break structure to the upside. And then we'd also like to see two break of structures to have confirmation. In this case, what? This is the high. This is the low, right? Unless we break the high, there's no reason for that shift. We're still bearish. We make equal lows. People are buying off both of these levels, their reactions. But then what happens? Supply, the sellers are stronger and they overpower demand, break structure to downside. All these buyers just got taken out. Push price lower. The lows are weak, the highs are strong, pullback, break structure. Each time we're leaving behind supply. Supply is only left behind in an area where we break structure. That's the only time when you have valid supply that you really want to look at. In other cases would be internal structure with flips. That would be something else. That's a different lesson, right? Now what happens? Now that we have let's move this a little bit to the right. Now that we've done what? We've had the corrective pullback bullish, we've tapped higher time frame supply, we've had an impulse continuation bearish that broke structure to the downside. Whether it is a low momentum break or high momentum break, it doesn't matter. In this case, let's just assume it's a high momentum break and we're coming back to the extreme, right? So now what do we get? We're getting that shift. We break 2 points of structure once we break this level, right? Or maybe somewhere in here, somewhere in between, right? On the lower time frame. What do we have? Price comes back to the supply. You don't want to take shorts now because we've just recently broken structure to the downside, right? We've done so with a lot of momentum. And so while you might think that we could continue short, we need a corrective pullback to build more liquidity and meet the mitigations needed to continue the move to the downside. And remember, you want to take shorts out of premium, not in discount territory. So we want to wait till at the minimum we hit the 50% level. And even then, you need full confirmation. Because remember, we're continuations. Focus on continuation of market structure. Reversals only signal through confirmation. We are bullish until we're not, and we're bearish until we're not. Stop looking to take shorts on pullbacks when we are, let's say, in a corrective pullback, right? Stop taking buys in a corrective pullback of supply, right? You don't want to be stuck in the wrong direction, right? You have to understand what stage we're currently in. So price taps, what do we have? The reaction to the supply, it looks like it might hold. We form an extreme. This extreme breaks that supply. Takes 1, 2, 3 levels, breaks structure to the upside. We've now tapped, we've liquidated, we've mitigated, right? We pull back. We're, in this case, what happens? We fail to make a higher high. We're making what? Higher lows and higher highs. Higher low, fail to make a higher high. So we've given a reaction here. A lot of people will think this is a great place to sell from and they'll go short. Well, what happens if we do not have enough strength to take the higher time frame move? Then we might search for orders by taking liquidity, a sweep of equal levels or structural liquidity. In this case, what? We're bullish. These equal highs are going to serve as liquidity for continuation to the upside. But before that, what do we have? A weak low. This low, this higher low, failed to make a higher high. Therefore, we have to sweep this level. We take structural liquidity, right? And then we, with a lot of power and aggression, we push price higher. You're going to see this happens all the time. When we fail to break or continue the structure, we will sweep, right? And this is an internal minor sweep. Break structure to the upside. We get a reaction, pullback, right? Continuation, right? What do we have? Higher high, higher low, higher high, tap. This is into reaction. What does this give us? Break of structure to the downside. It's a sweep. It's of structural liquidity. But what? We do not take shorts because our confirmation will be when we take out 2 levels of structure on that time frame. We know that this is 1 and this is 1. This level pushed price higher, but this level also pushed price higher. So this is the first one that has to fail, right? And then this is the next one that has to fail for confirmation. We'd go bearish once we take out both of those levels, which we did not. We just took out 1. So we continue higher. Price pushes up higher. Reaction failed. This is the decisional. We pull back. We have a demand that pushes price what? Into the extreme. We fail to make a higher high on higher time frame market structure, meaning this is the high. We have a low. We don't make a higher high, so the expectation is what? Higher low because we're bearish. So we're now correctively pushing back down, right? And then what happens? We break structure to the downside. We make demand fail. So now what's happening? Now we've had demand fail a couple times for structural liquidity, but then what happens in this case? We also fail to make what? A higher high. We break structure to the downside. We pull back. The pullback what? Does not create a higher high either. It mitigates the supply that broke this demand. And now we continue with the higher time frame impulse continuation bearish. And that's what happens. So that's kind of what I wanted to go over in this video. And the reason why is because it's very easy to get confused with market structure. There are a lot of details to market structure that people leave out, right? So to go over this part again, just to give you a review, right? The expectation, focus on continuations. If we look at the price chart here, let's just say here, right? How often are you going to have reversals? Not very often. This is a pullback. Does not make a new low, pushes higher. Pullback does not make a new low, goes higher. You would much rather take longs, pro trend on continuations than you'd want to take corrective pullbacks, right? Because they're going to be a lot more profitable, right? So two ways that you can, let's say, start counting when market structure is beginning to fail and shift, right? When we fail to make the expected level, so if we're bullish, when we fail to make a new higher high, right? Or when we're bearish, when we fail to make a new lower low, that's one, right? And then two, the shift in momentum and break of protected levels, like this, right? Remember, this is responsible for what? Breaking structure to the upside, creating a new higher high. When a protected level goes, that's sign number two, right? When we are, in this case, bearish to bullish, when a level that's responsible for printing a new low goes, that's supposed to be protected level, we break structure to the upside now, we are shifting. A tip to avoid traps that happen all the time, every day on every time frame is wait until we get two levels of structure broken on any time frame once you've shifted and had confirmation. This will save you from a lot of mistakes. Don't forget it. Apply it, test it, whatever, right? Now, remember, the market is what? Corrective pullback impulse. Corrective pullback impulse. Whether we're going bullish or bearish, right? If we're higher time frame bullish, then what's going to happen? The continuation impulses are going to be bullish, right? Look at this. Let's see on the 4 hour. Let's go to maybe the 15 minutes. So it's something like this, right? So look at this. In this case, let's say we are bullish, right? Because it's very clearly bullish on the 15 minute, right? This was a previous high. Let's mark some out just so that you have an idea. This was a previous high, right? Previous high. These are all highs that are going. When we're bullish, we are taking the highs and protecting the lows. There's no reason for price to violate any of these lows, because if we take out these lows, which have taken billions of dollars in accumulation just to take price higher, we are basically whoever, the people that are making the market move, because we're the small fish here, they're basically taking themselves out. There's no reason to do that. They want to protect these levels. There's no incentive for them to target these levels until what? Until the market has shifted. In this case, remember, let's say here we are bearish, right? Very clearly, we are bearish. Here, low, higher low, lower low, lower high, lower low, lower high, lower low, lower high, lower low. They're stacking orders here. There's a bunch of sell orders in here, and therefore there's no incentive for them to take out their distribution of supply here, because they want to take price lower. And so you're going to see that the build-up, the corrective pullbacks, right, are going to be slow and building manufactured liquidity, and the shorts in a bearish market structure are going to be impulsive, right? Once we've shifted, here we had a, what do we call this? A lower high. We make a lower low. We make what? Oops, we shifted higher high, right? Okay, well, let's see what happens. We break 2 points of structure here already, right? In this case, this low makes this high. Why would we come all the way back down to break structure to take these levels if the whole goal is to take price higher? They have a lot of buy orders here. This is where they're buying price from. So every time we break structure, unless we can get in at a mitigation, right, there's no reason for them to drive price lower. right? This is a great mitigation. But look, all this did was make perfectly equal lows. It did not liquidate that level. There's no reason to. This is where they wanted to be to get this buy, right? So back to that, so we don't go on a rant on that, right? Yeah, follow corrective pullback and impulse continuation. When we get the impulsive continuation that breaks structure, pay attention. Is it low momentum or high momentum? If it's high momentum, we'll probably come back to the extreme. If it's low momentum, we'll probably come back to the decisional, right? Pay attention to supply and demand. How is price reacting to supply and demand? It's either going to hold, provide a reaction, and then get liquidated, or immediately become liquidated. Now, what do you want? If it's holding, you want to get in every time you come back to a mitigation of a strong level that holds. If we are bearish and price comes back to mitigate a strong supply, you want to take the continuation. It's not going to get violated. It could be swept with a wick. That's a different story, another lesson, but unlikely that this level will be violated because we are following the higher time frame intention. And in this case, because it's bearish, the the impulse continuation to the downside is much stronger than the corrective pullback, right? The continuation is going to break structure on the higher time frame. The pullback is going to mitigate a supply that needs to be mitigated for continuation. Like if you look at here, well, on this time frame, whatever time frame this is, if this was a much higher time frame, what would this be? This would be a corrective pullback. We tap, continuation with aggression breaks structure. Corrective pullback, impulsive continuation, right? Same thing. It works on all time frames. Price is fractal, right? When we get reactions, does the reaction sweep liquidity and then break structure, right? In continuation, then we'd like to enter at the mitigation because that's a very safe entry. If the reaction does not take liquidity, well, is there a point of interest above where we could use that initial break of structure as what? Inducement, right? When we break two levels of structure, that's when we know price has shifted. Price could very easily break structure, right, for a sweep. And remember, that's why we like to use 2 points of structure for a strong confirmation, right? Pay attention to all those things. Hopefully that this video did it for you and you learned a lot from this. Let me know if you have any questions, you need any clarification. I might make a part 2 in the future. I am unsure right now. But just let me know what your thoughts were on this one. Hopefully you learned something and I will catch you for the next video. Enjoy your weekend.